What's going on YouTube? It's Gan and Mo. Today we're going to be discussing how to analyze the numbers on your next real estate deal when there's financing involved.
Now this video is meant to serve as a continuation of our last video in analyzing your next real estate deal. So let's dive right into it.
First off, you'll need to figure out how to estimate your monthly mortgage payment. And you could easily do that by plugging some basic numbers into the calculator I have here on the screen right next to me. And I'll make sure to leave a link in the description below so you too could figure out how to estimate that payment. You will need to know the purchase price of the property along with the terms of the loan. And that will include the interest rate along with the duration of the loan. Make sure to speak to your lender if you haven't done so already so you understand what you qualify for. You also want to know your annual taxes along with the insurance on that property. Those last two items are for those of us who like to escrow their insurance and their yearly taxes into their loan.
Now to get this party started, we want to start off by calculating net income after financing costs. Now with any rental property, you want to know how much money is left over after rent is paid and you deduct the financing costs. And in order to do so, the formula we will be using to calculate pre-tax net income after financing costs is net income after financing costs equal net operating income minus financing costs. Now in a previous video, we showed you how to calculate net operating income. So if you need a quick refresher, just check out that video with the link above.
Now that you know how to calculate your net income after financing, you want to set your own goal for what the minimum amount of cash flow that you are comfortable with per property. For instance, your goal might be to have $150 per month per unit. So on a 4-unit property, that comes out to $600 in net cash flow per month. Just keep this in mind. This is the number that will ensure that your property produces enough income to pay for your lifestyle once you start to take it easy and you decide that you want to sit by the beach and sip margaritas all day.
Now after calculating net income after financing costs, we want to calculate one of my favorite formulas, and that is cash on cash return. Now, cash on cash return will let you know how much of your upfront cash or down payment comes back to you in cash per year. Now, in order to calculate your cash on cash return, we will be using the formula net income after financing costs divided by down payment or total cash invested. That will give you your cash on cash return for your investment property. So for example, let's say that your net income after financing costs on your investment property equates to $600 per month. That's $7,200 per year. And your total money invested into that property was $125,000. That includes down payment, repairs, maintenance, etc. All you have to do to calculate your cash on cash return on that investment property is take $7,200 divided by $125,000 of your initial investment. That will equate to 5.76%. 5.76% cash on cash return per year.
Now the next two examples we're going to be sharing with you are where the cash on cash returns start to get a little bit muggy, and it does not serve as the best representation of the deal that you're trying to analyze. If you have a small down payment as in a higher loan to value, the cash on cash return is actually not very helpful. Say you invested $5,000, and yes, it is possible. Think a first-time homeowner who used an FHA loan or a veteran's loan, decided to live in the place, then decided to rent it out. And once he rented it out, he is netting $400 a month. And that comes out to a 96% cash on cash return. Now a 96% cash on cash return is just nuts. It's not something that is very accurate whenever you're trying to compare one property against another. This example is actually a product of a situation and capitalizing on that situation, and not the best way to compare one property against the next. Now another example where that cash on cash return is not that accurate is whenever you have no money into that deal. You could do that by bringing a group of investors together and showing them that you have a proven track record of finding great properties. So in this circumstance, your cash on cash return is actually infinite, even with minuscule positive cash flow.
Now while the above two examples sound really cool and hopefully provide you with that immediate boost of confidence to go start investing in real estate, just remember, such cash on cash returns are usually accompanied with extreme leveraging. Now, we love leveraging and we highly recommend it. Just remember that leverage magnified returns can also lead to leverage magnified losses. However, if leveraged appropriately and successfully, you should have more cash to invest in more deals. So to tie this all together, the cash on cash return is a tool best used to analyze investments with larger upfront cash. That will ensure and compare your investment to other potential investments on a cash-on-cash return basis, such as CDs, dividends, stocks, etc.
Knowing how critical cash flow is to the real estate investor's survivalhood, it's very important that the properties we choose have a premium cash-on-cash return compared to the lower hassle and lower risk investments. So if the risk-free government bonds are producing 1 to 2%, we certainly need to be doing much more than that. We typically look for between 12 to 15%, with exceptions if we have other plans for the property long term.
Now, we went through a lot of numbers, not only in this video, but in the first video of our series. I mean, whoever thought they would still need to know algebra and geometry and all these math equations after high school or even after college? I thought that stuff was done for. But let's tie this all together and let's determine the income component of that real estate investment property you're looking to purchase. So, Mo, break it down from start to finish.
First, find a potential property to evaluate. Second, study current market rents and current operating expenses. And for a quick analysis, you can always use the 50% rule. Next up, create a snapshot of the property's income by calculating the gross rent multiplier, the 1% rule, the cap rate, the net income after financing, and your cash-on-cash return.
And make sure to study comparable sales to estimate the current value, or better yet, after repair value of that property. This will give you a better idea as to whether that real estate property is profitable, what you should offer for that property. Are they lowballing you? Are they highballing you? And better yet, is that property a deal or no deal?
We truly hope you enjoyed this video. Make sure you hit that subscribe button and bell if you haven't done so already.
And don't forget to check out our next video and our last video of this series that's going to be pertaining to the equity component of your next real estate deal. And we'll see you next time.